So how's your recovery going? Well, let's take a look here right quick. What I've got here is a slide of what's happened in the public markets. You can see the S&P 500 over the last 12 months. And so at least securities and whatnot have bounced back rather nicely. The most impressive thing for the last 12 months, if you look at the reflection of the bond yields, which represents a significant decline in interest rates over the last 12 months, getting some to question whether there is indeed a bond bubble going on, but we'll deal with that later. So did the recession end? If we look at really that last box on the right-hand side, and we see those GDP numbers, I think you'll all remember that the last quarter's GDP was revised down from something like 2.4 to 1.6. You really don't see revisions that strong. So you begin to wonder just how strong this recovery is. So to kind of measure that real quickly, and this is a very busy chart, it takes a while to look at, but the thing to look at is those bars that show you the range of each recovery's, how far the range is in every recovery cycle. And the point I'm trying to make here is you can see under the consumption, it's nowhere near the height of the range, but in terms of inventory adjustments, it is definitely at the top of the range. And the point here is there's a very strong indication that what we've seen is just inventory restocking and not a real recovery taking over. Here we see the unemployment chart, and you can see it's flattening out. So, in the recession that we've supposedly moved out of, but at Kanaly, it's our contention that employment probably will be a leading indicator this time around rather than a lagging indicator. Before consumers can begin to consume again and pay their mortgages, they're going to have a job. This is, at least in our business, this is something that we look at very carefully. And these are the initial jobless claims that are posted every Thursday. And we had one just yesterday, but there's some debate about it because 9 states didn't report, one of them being California. But as you can see, the unemployment claims are starting to rise again, and this is sort of the leading indicator for joblessness in America. Lack of credit, I'll let Mr. Stevens talk you into the fact that they're lending money out there, but according to this chart, they're not. And so so you can see that credit has, from the peak, has really dried up. Now there's a constant here, so it's not like there's zero credit out there, but you can definitely see a decline in the availability of credit. This slide, if you were here last year, you'll remember I had this one here, and it's we're still not through the reset of all the financing, the clever financing we did over the past several years. So the green bars are the subprime mortgages that really stubbed our toe and moved us into this situation. But now we're into more prime loans and alternative A that are going to be refinanced. Into next year, we have another peak. So another refinancing cycle is upon us in 2011. So after we take away a government stimulus program for housing, you can see how the housing sales go, and this is quite a precipitous decline off of what was already a very significant one to begin with. So this will, if it hasn't gotten your attention, it really should. You'll probably wake up tonight thinking about this one. But it's a really powerful thing, talking about if you put a stimulus in place for a short period of time, you'll have a short-term boom. You take it away, there you go. So we took the sale off and everybody left the store. This is total debt as a percentage of GDP, and it's a belief at Kanaly that at some point you exceed your capacity to service your debt, just as households ran into that problem. In 2008, we could conceivably as a nation exceed our capacity to service our debt. And it's a dynamic problem, because if your GDP stays flat or continues to decline and your indebtedness continues to go up, the spread can widen very quickly. So Does the government have more capacity for stimulus? Another busy slide. I apologize for this, but you know, it's a slide that shows you what the total government revenues, what they're taking in versus what they're laying out. You can look at it for both state and federal, or you can just look at federal, but in any case, you're really getting to the point to where you're exceeding your capacity to do so, at least at the government level, although they don't seem to talk that way. So key economic issues for the remainder of this year and going into next year. The question is there going to be a withdrawal of the fiscal and monetary stimulus? It's really been an unprecedented stimulus on behalf of the Federal Reserve. We're talking trillions of dollars here on the Fed's balance sheet. Bank reserves, Steve will tell you, are at an all-time record. So the money is there, but the velocity of the money that gets into the economy is not. The question is what the Fed can do to exit before they create a velocity situation that is inflationary, which at this point I'm sure we would all take a little bit of inflation, wouldn't we, over a deflationary cycle. Efforts by China to slow its economic situation. You begin to worry about we're all hitching our wagon to emerging markets to pull us out of this, and the question is can that engine pull the entire global train? We have the mortgage resets, which I touched upon, so we have an even larger batch coming through next year. We'll see how that goes in the face of mounting unemployment. Continued deleveraging of consumer balance sheet, which in the end is good news, but it doesn't do much for consumption in the near term. And then we have facing the potential for tax increases, both federal and local levels. The Bush tax cuts, as they're called, expire next year whether Congress is in session or not. It does not take a vote for those cuts to expire. And then the potential for higher interest rates at some point when capital markets decide that we may have indeed exceeded our capacity to borrow. So here's the earnings for the S&P 500, and the one thing I want to point on this slide about the estimates for 2011 is they're estimating earnings going all the way back to the peak earnings of 2007. And I don't know about you, but that just doesn't seem to hit me as right, that we're going to be right back where we were in 2007. So my point of this slide is be wary of Wall Street estimates on earnings going forward. I'm just not sure where they're pulling these numbers from. They've done a marvelous job on profitability, but you would still need some top-line growth to get back to 2000 levels. So where's everybody investing their money? Well, in the late 90s, they put all their money in stocks, and they didn't put very much money in bonds. And today, they're not putting much money in stocks, but putting a whole lot of money in bonds. And so if you're a contrarian, you probably look at this and say, my goodness, I had no idea that that much money was flowing into bonds. And is the price of bonds the bubble of the past? Well, we can debate that one. So what we're looking for at Kanaly is probably a repeat of the experience we had from 69 to 83, a very, very choppy market. If the Fed does succeed in reflating the economy, then you have the experience you went through in the 70s of pretty good inflation, but not much growth in common stocks. So at Kanaly, what we're doing for our clients is we're pursuing an ultra-diversified portfolio. What that means is you're doing things other than just buying and holding stocks and bonds. And we're utilizing a number of alternative assets, even gold, of all things. Why would you buy an investment that doesn't pay a dividend? You got to pay somebody to store it, and you can't eat it. But we own the stuff. For equity exposure, we are looking globally for it there, but so is everybody else, and so you want to pay attention to those valuations. And then in fixed income, we are very short in duration and very high quality. And believe me, we are going through our portfolios every day. If you read the paper like I do, you'll notice every day the bond defaults are sort of creeping up to the front page, as they go along in municipalities. And we would expect that to accelerate. And that's not going to be a complete municipal bond collapse, but you definitely want to look at the credits that you might own in your portfolio. And then at some point here before long, we're going to be adding inflation protection as commodities get cheaper. So what does that look like? The old traditional portfolio looks 60-40. It has a typical return of about 7.6%, but standard deviation for us is still quite high at 10.7. Our strategy, our expected return might be as high as 8.6, but we like that standard deviation the way it compresses the volatility. It enables you to compound a dollar, at least the probability of compounding that dollar is much higher. So what does that look like in practice? Oh boy, even I can't see that one from here. But what that looks like in practice is, if you look at this chart, and I'm happy to share it with you afterwards, you'll see that generally when the market is down in a particular quarter or month, the portfolio that has the alternative assets in it just does not see that type of dip. And if that dip gets to be prolonged, then your dollar's preserved. You don't see the returns on the upside in a portfolio like that, but that's not what we're after. We're trying to protect that dollar and compound it as best we can.